Hello and welcome to the course. Thanks for everyone for staying in. Let me know if you have any issues with the quality. Let me check the quality myself. It should be 720p. If you have any issues with quality, just make sure your settings are on 720p. And now let's get back. So for today, in the schedule, which you can find in the core folder, in the schedule, we covered so far today, it's module 3 already. Time passes really quick. So we covered a revenue recognition, and we also we did some study on accounting accrual process and accounting accrual basis versus cash basis in the previous lecture, and we continue to do so. So the link to the lectures is here, to the MIT materials. In that, these materials, they are still relevant most of the time. So basically today we will discuss how like an accountant's work day will look like, and if you have any questions about that, you can ask questions in the chat or you can submit them through Q&A. So let's look what we have here. So that's a general description of accountant functions, and it says that accountant classifies and summarizes transactions, made it easier by repetitive nature of business transactions. So basically your accounting routine, it will be more or less the same every month. If you are the only accountant in the company, you will receive invoices from vendors. You will enter those invoices like an expense. Then you will record payments to vendors. So you will pay those invoices. So you will recognize the expense. Then you will pay the expense. You will pay the bills. Same with the customers. You will invoice customers. You will invoice customers when the sale occurs. You issue an invoice and you send it to a customer, and then you wait for a payment. And when you get a payment, you will recognize like credit, accounts receivable, debit, cash. You will recognize a cash receipt. So basically most of your day-to-day routine during the months will be like going to QuickBooks, entering, okay, you can enter expense if you paid it already. Let's do some expense here. Let's make a new vendor, service vendor. So you do an expense. You can do that through, if that's some service which you routinely buy, you can enter it here, or you can enter it here. Like, let's see if you have utilities. Yeah, we have a utilities here. Let's assume we bought a utilities and we pay 500. 600. Okay, let it be 600. And that's basically, we save and close. And let's see where we have okay, I need to make a step back. I wasn't paying attention properly. I have probably entered that to as a wrong month. No. Okay, let me just re-enter that expense. Service vendor, utilities, let's make 550. And what was the date? October 31st. Okay, let's save. Let's look at the profit and loss. Utilities, yeah. So both utilities are reflected here. So when we, for example, receive a bill for utilities, it's usually like a previous month's bill. But let's assume we receive a bill currently. We received a bill for the current month. So in the current month, as of October 31st, we should have accrued for these receivables and utilities and reflect them in the expenses. And let's see if it was reflected on our balance sheet in the trade payables. Accounts payable. I have 0 here. So basically, should this have been reflected in cash? Mortgage, prepayments. Yeah, basically, if we run it through expense, we reflect it. It is reflected in the cash. Now let's try to do that on credit. So let's assume that we are an accountant in the company, and we do not know how much we will owe on utilities at the end of October, but we still need to reflect some expense. In that situation, we make an estimate of the expense. And let's see how we can do that. Usually, we will do that with a journal entry, which we will then reverse when we get the actual bill. So let's say in September, it's September month end, and we do an accrual. Oops, sorry. Accounts payable, other current liability, accrual for utilities, detail type. Okay, what happened here? Okay, accrual for utilities and utilities expense. So we accrue 500 debit and 500 goes towards utilities expense. Now we make save. Oops, sorry, the date should be September 30. Save. Then in October, we would get a utility bill with actual. And when we get a bill in October, then we will reverse September entry. First we will bill that, choose a vendor, let's make utility as a vendor. And we received a bill in October. Let's assume we received it October 1st. And we have a due date somewhere in October. And then we kind of record, I don't think I have utilities here. Let's just reflect it here. Utility expense, and let's say it was 566. So we got 566 bill, and we reflect it as an expense. Now because it was let's say utility bill for September. Now we kind of double counted our utility expenses. Let's go to the income statement here. September 1st. So as you might see, okay, what happened to it? I probably used debits and credits incorrectly. Yeah, my bad. And no one has corrected me. That's not a good sign. Okay, so let's see. We did an accrual for 500 in September. Now we received a utility bill in September, and we recorded it. And that was for a different amount compared to the September. So what we need to do, we need to reverse September accrual in October. Let's just do that. Again, do journal entry. And we do that on October 1st. And we do accrual for utilities. So our amount was 500, and we do a reversal. So it will be debit and credit. Credit for expense, which is kind of reduces our expense, which is kind of an income. Okay, so now we recorded a liability in September when we consumed. Sorry, it continues to adjust the timing for the report. So we recorded 500 in September, an estimate for the utilities for September. Let's just say it here. Utilities. Estimate of utility bill. Okay, so we accrued utility bill in September, 500. Then, at the 1st of October, we kind of reversed that accrual. Later, usually, let's say we get a bill on 15th. Bill date. 15th. Save. Okay. We got a bill of 566 for September. Now we are on October 31st. and we need to make an estimate for October again. And let's assume our estimate, so it's getting colder and we spend more on utilities. So let's say our estimate is 800. And we do that estimate through journal entry, account, accrual for utilities, and utility expense. And okay, so that should increase on credits, and let's say it will be 800 and 800 expense here. If you have any questions, you can ask that. Okay, so we reflected that. Let's make sure that we show everything starting from September. It's still getting back to just October. Okay, and let's just delete these two so they will not mess with our okay. Okay, I will just push them to November then. Okay, September through October. So first, we started a business in September. We reflected our estimate for utilities in September, 500. Then in October, that should have been October 31st. Then in October, we usually reverse what we accrued in September. Then we enter an expense for the actual September bill. And then at the end of October, we make another accrual, our estimate. Let's say that here. Estimate for October utilities. So what is the ending result? Let's see here. So September. Okay, so the total expense for 2 months will be 1,366, which is the actual, which we already know, and which is our estimate for October. But let's look on October. Don't we double count? So if we run solely in October, we will see that the actual for October is 866. And that's kind of higher than our actual for October. And that's because we did some correction related to September because we got the bill which is higher than what we reflected in September. Now what's an interesting part? It is that it's okay to have such a discrepancy, and everyone understands that if you need to close the September, so there usually like some time you have during the months, next month, to close the previous months. Usually it's like 5 days, So you are expected to close your monthly transactions during the first week or maybe couple of weeks of the next month. And sometimes you do not get all the bills timely, and you do not reflect the actuals in your months. That's why you do the estimates. So let's get back to your accounting, to our accounting procedures here. So we classify and summarize the data. And accountant usually knows all repetitive transactions on the business. And if accountant doesn't have a bill, doesn't have an invoice to accrue something, he will usually make an accrual based on his judgment, based on his estimate. And every account in your chart of accounts is just some kind of form of a storage unit for these transactions. Okay, and now we come to the T accounts. I don't know if you remember that from your studies. Back in the day when most of the stuff was done on paper, T accounts provided some kind of a form of easier understanding of intercourse of debits and credits. And again, this is some kind of a repetition that increases in assets are recorded on the left side of the T accounts, and left side is a debit. So basically that kind of repeats a debit and credit conversation. I have some paint here, and so what we can basically do is just say, okay, so this is a T account, this is a debit, this is a credit. So assets, yes, if it's an asset, if it will increase on the debit side, it will decrease on the credit side. If it's a liability, it will be vice versa. So by now we should already all know that. So what interesting do we have here? Yeah, that's pretty much summarizes it. Assets, liabilities. So these are debits. Left side is debits. Right side is credits. What is the purpose of all of that? It's just to show you some simplification. I'm not sure that with the advances in spreadsheets, when everyone uses in spreadsheets, I don't feel like T accounts are relevant anymore. But let's do some a bit of flashback 20 years ago. So what do we see here? We see that instead of recording all the income and expense transactions in the retained earnings, we do a separate T accounts for every account. So every account has a sub account, and then we calculate the totals for every account, and then we close the totals to these two here. Let me just do a quick exercise here. Print screen, and okay, that might not look nice. So basically I will move expenses. Oops, what is that? Oh, dividends. Okay, I do not want to touch dividends. Okay, so I will move expenses to the left and I will move revenues to the right here, and I will move retained earnings to the middle. Okay. Okay, let's move rent here. Interest, dividends, salaries. Okay, interest need to go up a bit. Dividends need to go down a bit. Salaries. Okay, so the purpose of T accounts was that you run T account for every account you have where you have transactions. Then you calculate the total. So revenues, as you remember, right is credit, left is debit. Revenues increase on the credit side. Expenses increase on the debit side. And dividends are kind of similar to expenses. And at the end, you kind of close every account. At the end of the month, you close every account. So you calculate the total and you move it here. Salary expense here, interest expense here, dividends goes here, sales revenue goes here, interest revenue goes here. So at the end of the month, you close your revenue accounts, and technically, so you like debited an expenses during the month, and at the end of the period, usually a month, you send the totals to your retained earnings, which means that technically you kind of have zero everywhere, so your balances balance. That logic, it worked good on paper. Now with the spreadsheets, we cannot say that. It's hard to understand initially why can we have zeros in these accounts if we have transactions. So let's assume we were in month 1. At the end of month 1, we need to create some form of the balance sheet. And let's assume if all the transactions were in cash. Can we assume that? So basically we earned, that is our closing retained earnings account. So on our balance sheet we will have cash, in the assets, and on the other side we will have retained earnings. So since we closed everything and we assume that everything was for cash, so it was, I probably need calculator here anyways. So, but I would believe that number. So at the end of month end, we have 4,150 in retained earnings. And because the balance should balance, and we assume that we paid all those expenses and dividends and received everything in cash, we say that our cash was 150,000. So in the end of the first month, we kind of reset all these accounts to zero. Okay. Okay, can I? Okay, it doesn't allow me to have several paint files open. Let me circle back here. Okay, so this is our month 1. Let's take a step here. Not that lecture. Where it is? Okay, so we kind of closed month 1. Again, we have a discussion here about what increases retained, so the revenues increase, retained expenses decrease, retained earnings. That's we have already covered all of that here. It's just a repetition. Dividends decrease retained earnings, expenses and revenues, debits and credits. Retained earnings general has a credit balance. Revenues has, yeah, it's all repetition of what we have here, but with interpretation related to the T accounts. Okay. Debit ledger. Accounts are collectively referred as a ledger. So basically, when you say general ledger, when you say trial balance, it's more or less all the same. What we have interesting here is that balance sheet accounts or real accounts or permanent accounts. So balance sheet accounts are the ones which accumulate the data. So we see how did everything here closed to the retained earnings. But let's, for example, take expenses. Let's see. Let's go here. Okay, let's copy that. Okay, let's copy just about everything. Paste it here. Can I will just get more space here. What entries did we do when we get done with all of these entries? Basically, as we discussed, as I advise to assume, we say that we all of the transactions were closed to the cash. So we got 2 of these here, 800, 400. I will make totals further, but so we got 800 here, and we got 1650 here, and we got 2000 here from the dividends. And that's a credit. Right, on the right we have credit, on the left we have debit. So basically when we did these entries, when we did expenses, for simplification we assume that it was all cash. It all went to the credit of the cash, and these items, 8500 and 1300, they all went to the debit of the cash. So at the end, when we sum this up, okay, let me try to do it. So these are 2,000, 4,000, 5,000, 5, 6, 50. And on that side, we have 9,800. And so that was a credit. So net will be 4,150. So as you see, in month 1, we got cash 4,050 and retained earnings 4,050. And the reason to have all these T accounts is that you can place them so that if you match them with a link right here, so if one has a credit here, you need to match it with some debit. In our case, I used cash, and that way you kind of it is assumed that it will be easier for you to understand like why debits are equal credits, and maybe it will provide you some intuition how to pick the other account. So that was the month 1. Now let's discuss how do we live with these zeros. Let me save that as a different component. Month 1 cash, save. Okay, we have all of the same stuff here. Now what do we have? What do we have at the beginning of month 2? Remember, our income statement account, revenues and expenses, they should flush, they should close at the period end. So let's start from scratch probably, and let's take a look at the lecture. I think they will have that. Journal entries, adjusting, posting, trial balance, financial statement preparation. Okay, they give us, let me see. Okay, they do not cover that. Maybe they will cover that in the future lectures. Let's see where. Okay. So that's our cash. That's our retained earnings. And that's month 2. Let me make it a little bit smaller. Okay. Okay. And on the cash, let's switch here. On the cash, we have 4,150, and that should be a debit, and that would be brought forward 4,150, and our retained earnings will be the same amount. I will just use brought forward 4,150. So that's month 2. Just highlight. Okay, 2. Month 2. Now we can have the same transactions in the month 2. Okay, can I just copy it here? Most of the transactions will repeat. Let me downsize it a bit. Okay, so it's probably let's say we just got the same interest revenue. So we got interest revenue here, and we received 1,300 in cash. Oops, we received it here, 1,300. And same at the end of the month, we close. So interest revenue was 0 at the beginning, but we made it again. Let's assume that was month 2 income. Let's assume that that was the only transaction which happened in that month. So now when we close it, we send it back to retained earnings to credit. 1,300. It might be not very intuitive. So by practice of T accounts, it is kind of considered intuitive to place them so that you can move it with a straight line. But I will just show. So that's basically the same. That's the same transaction, not two different transactions. And that way, again, we zeroed out that account in month 2, and at the end of the month, we have 5,450 here and 5,450 here. That's what T accounts are for. Let me know if you need more information on T accounts, and I will then probably make a separate video about that. But my personal opinion is that when we switch from paper to like a spreadsheets, we need to learn everything in the spreadsheets, and T accounts are kind of obsolete right now, and I don't feel like they provide a lot more insight here. The only useful insight is that we got a understanding how and why we zero out every month interest revenue in the T accounts, not in the company, just in the T accounts. We zeroed it out and close the balance sheet accounts, and that balance sheet accounts are cumulative in nature, and income statement accounts are periodical in nature. So that doesn't mean that, like, if we imagine a database which makes inquiries, and for example the database make inquiry about interest revenue in the month 2, and that inquiry, it will pick up credit amount, credit turnover of interest revenue in month 2, and it will be 1,300. It will not be 0. So if we inquiry second month interest, it will be 1,300, not 0. So when you work in the spreadsheet, it's kind of very intuitive and very self-evident that if we filter period 1 or month 1 or month 2 revenue, we will get these numbers. Here, when we say, okay, we zero out the account at the end of each month to close the book, it is just not very intuitive. Okay, let's finish with the lecture. Let's finish. So basically, what will you do as accountant? You will record journal entries. Remember, like the one with utility. You record like an estimate in utility, then you might have adjusting entries. If you get some bills for some goods or services which you get within the month, you just post them. Then at the end of the month, you might need to make an adjusting entries. You might need to make new estimates, or if you already received a bill for which you made an estimate, you want to adjust that. Then posting to T accounts. Again, there is no T accounts in QuickBooks. We do not usually work in any T accounts in QuickBooks or other software or in spreadsheets. So basically, that posting to T accounts is just summing up all debits and credits. Like in our homework. Remember, in our homework, we worked on transaction list, and we have accounting period here. And at the beginning, we put period 1 here. And our income statements. Where is my income statement? Okay. Our income statement, our trial balance, and then income statement. It sums all the transactions, cumulative. So the equivalent of journal entries will be summing if transactions by each period. So for balance sheet, you need to sum if cumulatively. While for income statement, you can sum if like a periodically. So that would be, we can use sum ifs function to do that. So we use accrual basis. Then we need to select an accounts, and we select the accounts which we want to sum if, which will be revenue products. And then we sum if by periods. So we sum if by 2 different criteria. And let's see where we have period 1 here. So the equivalence of that T accounts zeroing out will be summing if. Let me just fix. So I want to fix that column. I basically want to fix every column. When I press F4 and put like dollar signs here in the formula, I fix the columns in that formula. So when I copy the formula, these columns will not change. And for that one, I want a letter to be fixed and number to change. And for the Z one, I want a number to be fixed. Okay. So basically here, I sum ifed transactions from period 1, and I get only like only a few items. That's because I mapped to period 1 only just a few transactions here, and the rest is not mapped. And now let's assume I want to insert a column and introduce a period 2. Okay, and now I go into my transactions and I say, okay, let this be period 2 transactions. Let's just have some what's going on. Okay, and I will just copy the formulas here. Yeah, so we only mapped a bit of expenses here, and you see that for period 2 I have zeros here, so that is an equivalent to zeroing out the transactions. We are running out of time a bit. So basically, trial balance, that's basically what we did with our homework and financial statement preparation. Journal contains a chronological record of the transactions of a business. Yeah, that's true. That's our journal. That's our transaction list here. We have all our entries in chronological order. Let's go back to lectures. And again, here we have some repetitious transactions. We've already seen that. Contributed capital, cash 10,000, capital 10,000, borrows 3,000 from the bank, debit cash 3,000, credit loans payable 3,000. It's here. Purchase equipment for 5,000 cash, debit equipment, credit cash. We've already done all of these transactions. Services 12,000 for 8,000 in cash and receivable. Debit cash, debit accounts receivable, credit revenue. 9,000 for expenses, wages, interest, and maintenance. Journal entry. So for some reason they debit retained earnings here and credit cash, but we know that that should be debit some kind of expense, wages. That entry just looks like the one which you not posted correctly, but eventually it will go into retained earnings when we close the month. Okay. So posting, they shows how you would post that to T accounts. We've already covered that. Let's look at the last one. Company pays a dividend of 1,000. So it will be debit credit cash 1,000. And it's here, transaction 5. So summary, T accounts, debit is left, credit is right. Increases in assets, debits, increases in liabilities, credits. Decreases in assets, credits, decreases in liabilities, debits, increases in shareholders' equity, credits, expenses are debits, revenues are credits. And here we have a quick review of operating cycle, that sometimes we pay cash earlier than we recognize the expense, or we can recognize expense earlier than we pay cash for something. That's a reminder about the difference between cash basis and accrual basis. Not much to repeat here, honestly. We have 5 minutes left. If you have any concluding questions, let me know. Or if you have any proposition for me to make a separate video on some topic, just send me a message in Messenger or in Telegram, and I will consider that, and I will do any extra videos if needed. Okay, accruals. So we've already covered an accruals. Let's take a quick look at accrued wages. So we have payroll per day, 2,000, weekly payroll, 10,000, 5 working days. Year end is December 31st, and December 31st is a Tuesday. So December 31st was a Tuesday, and the payday is Friday. So on December 31st, there have been 2 working days worked, but the salary hasn't been paid. So we have incurred wage expense for 2 days, but will not pay in cash until Friday, January 3. So we accrue for a wage payable. We accrued for wage payable here. Debit wage expense, credit wage payable. If we omit that entry, our liabilities will be understated and our profits, net income, will be overstated. Okay. And if we talk about annual financials, the correct way, so if we have 10,000 per week and we have 52 weeks, the correct amount for the wage expenses for the year will be 520,000. And that should include that 4,000 accrual for the wages, for the unpaid wages. And here, when we pay the rest, we just recognize the rest of the expense. Same when we get paid cash for the inventories. We've already done all these transactions. Beginning balance, purchases, ending inventory. For the costs, we will look into the costs on the next module. So I will skip that for now. We basically come to the conclusion of our lecture today. Please send me any direct messages if you have ones. If you have any if you're just starting out with the course and you have any questions to me, we can have a conversation. And if you have questions how to run through course, I will explain that to you. So thank you so much and have a great rest of your weekend. I will schedule today's Q&A at 9 p.m. as usual, and let's meet on the Q&A there. Have a great rest of your Saturday.